The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. My name is Charles Ostroff. I'm the Chief Credit Officer here at Arbor. We'd like to thank you for joining us today for the webinar. I'll be moderating today's webinar, everything you need to know about small multifamily lending. But before I introduce our speakers, there's a few housekeeping items I'd like to go over. I'd like to let everyone know the webinar is being recorded, and the recording will be emailed to all attendees later this week. We will also have time for a quick Q&A after the presentation. So please submit any questions you have in the questions tab of your webinar control panel at any point during the presentation. If we are unable to get to your questions, just give us a call or shoot us an email. So let's get started. I'd like to introduce our speakers for today. Dustin Pavir, who is Vice President of Operations and Processing and has been with Arbor since 2008. Thanks for joining us, Dustin. And also Michael Nolan, Originator Sales Associates, who joined Arbor in 2004. I'd also like to welcome Michael to the panel. I'd like to give a brief introduction of Arbor. Arbor, for the last 9 years, has been a top 10 Fannie Mae lender. We've also been one of their leaders in the small loan space. Also, 2015, which was the inaugural year of the Freddie Small Balance Loan Program, Arbor was the #1 Freddie Small Balance Loan lender. Just a little background, and Dustin, can you introduce our guests to our experience within the two programs and our two lending partners?
Sure. Thank you, Charles. So as we can see on this slide, Arbor's two primary small loan products are the Fannie Mae small loan and the Freddie Mac SBL. Both of these loan products are geared towards market rate multifamily financing, and each agency has a slightly different criteria or box in which they will consider a small loan. So for Fannie Mae, they consider any loan amount up to $3 million, nationwide being a small loan. They will go up to $5 million in select strong markets, which are New York, LA, Chicago, San Francisco, etc. Freddie Mac, on the other hand, will actually go up to $5 million nationwide and even up to $7.5 million in select top and standard markets, provided a property meets certain affordability calculations. So the long and short of it, Fannie Mae generally up to $3 million across the country, Freddie SBL up to $5 million across the country. And then we can just see here, a few bullets. It just really shows the growth of the small loan market over the last, 5 or 6 years. And Arbor certainly has been very active in that space, as Charles alluded to in the previous slide. So, Freddie and Fannie both have, slightly different programs. So the next slide here that we're going to go into just kind of illustrates where both agencies can be competitive and how Arbor takes advantage of that, right? So this map here, we see a few states shaded here in dark colors, which indicate Arbor's most active small loan markets: California, Texas, Florida, North Carolina, and New York. Now, California and New York, for example, are really examples of where Arbor does a fair amount of business in top markets. We're very active around New York City, also LA. Both agencies in recent years have made efforts to really tailor their small loans to compete with local banks in some of these top markets, like Los Angeles and New York City, for example. Now, on the other hand, Texas is a very big market for Arbor, but Texas is generally a nationwide or standard market with some smaller, more tertiary markets as well, where Arbor does quite a bit of business as well. So, if you look at this map, over the last 12 to 18 months, Arbor has closed a small loan in pretty much every state in the country. So, we're very active, obviously, in these certain states, but really across the entire country in this small loan space. So, a few benefits of small multifamily loans, right? Number one here, non-recourse, right? The agencies, Fannie and Freddie in the small balance space offer non-recourse financing, right? Meaning no personal liability to the borrower. Most banks are generally doing recourse financing, so agencies are definitely a little bit more attractive when it comes to that.
If I can jump in here, these programs offer prepayment flexibility. So traditionally, these small loans would have yield maintenance, which basically would lock a borrower in for, essentially the entire fixed rate term. Be very expensive to prepay. But Fannie Mae or Freddie Mac through their SBL program, and now Fannie Mae on properties with less than 50 units offers step-down prepayment. For example, on their 5-year fixed-rate deal, it starts at 5% in the first year, steps down 1% each consecutive year. So it's like a 5, 4, 3, 2, 1 prepayment, giving borrowers the option, to either refinance or potentially, if they go to sell the property, they can get out of that loan fairly easily. So they've brought a lot of flexibility to the programs in recent years.
Sure, yeah, absolutely. And another big question that we see a lot is the availability of interest only, right? And both Fannie and Freddie will allow for partial term or even at times full term interest only, depending on a property's location and the leverage and the term, and we can get into a little bit more of that as we work through the presentation here. But interest only is definitely something we see a fair amount of. In addition, reduced fees. The small balance loans generally are going to cost about half of what we would typically collect for a conventional Fannie Mae or Freddie Mac execution. So fees are going to be less, and kind of segueing here into expeditious processing, right? As Charles alluded to, Arbor was the #1 Freddie Mac SBL lender in 2015. We've been a perennial top Fannie Mae small loan lender as well. And at this point, we have it down to a science. We know how to get the small balance deals done and turned around and closed in a timely manner.
And one of the benefits that you do have is that we have a small balance team that's
a dedicated set of underwriters that are only doing small balance underwriting. Absolutely.
There's also another thing I'd like to point out here is we've made some developments recently. We've launched a Loan Express platform, which is basically an online system for screening and processing these small balance loans. So everything is automated, and it really leads to faster turn times, and it simplifies the process. It's something we'll talk about later on in the webinar.
All right, and so Dustin, I believe you have a couple case studies for us to go over as it relates to some loans that we've done.
Yeah, absolutely. And this slide here that we're looking at right now, just kind of touches on some of the basics again that we'll see in the case studies. Interest only is available at full leverage, as I mentioned on the previous slide. In terms of maximum leverage, again, it somewhat varies depending on the market where a property is located. But the maximum LTV is generally going to be 80% LTV for an acquisition and 75% maximum LTV on a cash-out refinance. Minimum debt service coverage ratio is generally be a 1.25 debt cover. And as I mentioned earlier, full-term interest only can be available under both Fannie and Freddie, generally at lower leverage, 50, 60% LTV with a debt cover generally around 1.5. So the first case study that we have here is a Fannie Mae small loan refinance in Buffalo, New York on a 32-unit property. Buffalo is considered a nationwide market for Fannie Mae. And as we can see here, this was a $2.67 million loan that provided the borrower with $1.4 million of cash out. And this was done under the Fannie Mae 7/6 ARM execution. And the story that we saw here is something that we see pretty frequently, in that the borrower had owned this property for a while. They bought it in 2009. We had a local sponsor with 30 years of experience in the market, other assets. So we had a good comfort level with the sponsor. And over the course of his ownership here with the subject over the last 7 years or so, he put nearly $40,000 a unit of CapEx into the property to completely rehab the exterior and the interior. So it created quite a bit of value in the process. The $2.67 million loan was more or less equal to about 100% of the borrower's cost basis. But again, there was 7 or 8 years of ownership on the property and a good amount of value that had been created, and we had a local sponsor with a good presence in the market. So this was, and furthermore, the borrower was actually a repeat Fannie Mae borrower. We were repaying existing Fannie Mae financing with this transaction. So that's something that we like to see, and a story that we see quite frequently. The next case study here is for a Freddie SBL execution that we did on a 4-property portfolio in Portland, Oregon. And Portland, Oregon is what is considered a top market for Freddie Mac. And the story here was we had a borrower initially come to us with a refinance on a 42-unit property that was a $3 million loan that provided him with $1.5 million of cash out. That was subsequently turned around and invested into the acquisition of 3 additional properties in the market. And what we liked about this deal was that we had a local borrower, again, who had experience in the market. But this borrower had traditionally been a bank borrower. And, as I mentioned earlier, Freddie and Fannie are really trying to go after some of these borrowers who have been traditionally bank borrowers to show that the agencies really can compete in this space. And in this case, the SBL execution was a very attractive one for the borrower. We did 2 of these deals as 5-year hybrid arms, meaning fixed for the initial 5-year period, floating for the 15 years thereafter. 1 year of interest only was done on the 5-year deals, and then we did 2 of these deals as 7-year hybrid arms, meaning fixed for the initial 7-year period, with 2 years of interest only on the 7-year products. But this was just a good example of, we had a borrower who had owned the refinance for 7 years and was able to create a fair amount of value there and take that cash out, put it towards the acquisition to continue to build his portfolio in the market.
So it's also a good example of building a partnership with the borrower.
Sure, absolutely.
All right, Mike, I'm going to put you on the spot here since you're on the front lines every day. You're dealing with borrowers. I know the agency loan process for somebody who just gets into it can be a little daunting. But can you walk us through what they need to bring to the table for someone to have a smooth process?
Right, of course. So the first question we always get from borrowers is, what do we need to get started? So here's a quick list of some of the items we look for, in order to give an accurate quote. The first thing is a rent roll. We look for, to show the unit type, any concessions that are offered at the property, half rents or Section 8 voucher tenants. We'd like that listed so we get a sense of any affordability restrictions or whether or not the property is market rate. We also look for an operating statement, preferably broken out by month for the last 12 months. We also want to gauge the borrower's experience, so we ask for a schedule of real estate owned, showing the location of the property, the number of units, the length of ownership of each property, just to gauge how experienced the client is. We also ask for a personal financial statement that shows your net worth and liquidity. And then some other items, if it's an acquisition, we're looking for a purchase and sale agreement, or if it's a refinance, we're looking for a cost basis, any CapEx you put into the property, what you purchased it for, when you purchased it, that sort of thing. It'll gauge, how long you've had the property for, and essentially what you've done, how you've operated it.
So, Mike, there's a list of information that's here that everyone on the webinar can see. I mean, if I don't have all this, or if some of this is incomplete, am I ineligible? Am I not allowed to get a small loan?
Right, not at all. We're here, if you want to give us a call, we're here to, walk you through the process and really work with borrowers. On acquisitions, a lot of times some of this information might not be available, or if you're looking to buy a property from a mom and pop operator, sometimes they don't have the detailed trailing 12 statement.
And I'll just chime in real quick, on the underwriting side, we do see that somewhat frequently, where we have borrowers acquiring properties where the seller may not have kept, the best financials, or they're tough to get, or maybe they're inconsistent. So, at times we will go to Fannie and Freddie and request waivers or exceptions to, on the lack of operating history. Again, it's most commonly seen in acquisitions, top markets where we have quite a bit of experience in a given area and generally can get